There is a building in Ottawa that makes decisions that decide whether your mortgage payment goes up or down next month. Most Canadians have never been inside it. A lot of people don't even know what it does. It's called the Bank of Canada, and it is one of the most powerful financial institutions in the country. Today, we're pulling back the curtain in plain English on exactly what the Bank of Canada does and why it affects you personally every single day. Welcome back to KP Money Talks, and today we're going to talk about the Bank of Canada. Hit that subscribe button and let's get into it. First things first, the Bank of Canada is not a regular bank. You can't walk in and go and open a checking account. It's Canada's central bank. Think of it as the bank for banks. Its job is to keep the entire Canadian economy stable. It was created in 1934 and today it operates independently from the government, meaning politicians can't just call up the governor and tell him to print more money. That independence is actually really important, and we'll come back to why in a minute. The current governor is Tiff Macklem, and his job, along with the governing council, is to make decisions that affect the entire country's financial health. The Bank of Canada's most powerful tool is something called the overnight rate, also known as the policy rate. Here's what it is in plain English. Banks lend money to each other overnight, literally overnight, to balance their books. The rate they charge each other, that's what the Bank of Canada sets. And here's why you should care about it. When the rate goes up, borrowing becomes more expensive for banks, and banks pass that cost on to you through higher interest rates or on literally everything. Mortgages, car loans, line of credit, credit cards, everything. And on the other side, when the rate goes down, borrowing gets cheaper. Your variable mortgage payment drops, loans become more affordable. Right now in Canada, the overnight rate is sitting at 2.25%. That might sound small, but going from 0.25 in 2022 to 5% in 2023 to 2.25 today, that entire journey has been felt by millions of Canadians and their monthly payments. If you watched the last video, you already know what inflation is. But here's the connection. The Bank of Canada's primary job is to keep inflation at around 2%. Why 2%? Because a little inflation is actually healthy for an economy. It encourages spending and investment. But too much inflation, like 8% that Canada saw in 2020, burns through people's savings and destroys purchasing power. So how does Bank of Canada fight high inflations? Well, it raises the overnight rate. Higher rates mean borrowing costs more. People and businesses take out fewer loans, they spend less. Demand in the economy slows down, and eventually prices stop rising as fast. It's like Bank of Canada basically pumping the brakes on the economy. And going the other direction, when the economy is slowing and unemployment is rising, the bank cuts the rates. Borrowing gets cheaper, people spend more, businesses invest more, and the economy gets a boost. That's the balancing act happening right now in June 2026, with the next rate decision coming on June 10th. Here's something that surprises a lot of people. The government can't order the Bank of Canada to lower rates. Even the Prime Minister can't. Why does that matter? Because if politicians controlled interest rates, they'd be tempted to keep rates low before elections to make the economy look good, even if that causes inflation down the road. The bank's independence means its decisions are supposed to be based on data and economic conditions, not politics. Is it perfect? Well, no. People debate this all the time, but having a central bank that operates at an arm's length from the government is considered a cornerstone for a stable economy. So what does all this mean for your daily life? Watch the Bank of Canada's rate decisions. They happen 8 times a year. When rates move, your variable mortgage, your line of credit, and your saving rates all shift. The next decision is July 10th, 2026, and the analysts are warning that a rate hike could actually be coming in the second half of this year because of rising oil prices. That means mortgages could get more expensive again. Stay informed. Even understanding the basics puts you way ahead of most people. So, to recap, the Bank of Canada is Canada's central bank, its most powerful tool in the overnight rate, which controls the cost of borrowing across the entire economy. When inflation gets too high, they raise rates. When growth slows down, they cut. Every single Canadian with a mortgage, a loan, or a savings account is affected by what happens in that building in Ottawa. In the next video, we're tackling something everyone talks about but almost no one fully understands. It's Canada's deficit. What it is, why the government keeps running one, and whether you should actually be worried. Drop a comment below, subscribe if you haven't yet, and I'll see you in the next one.